Hello, everybody. This is Elena, and this is another episode of Podcast with Elena, specifically geared for investors who are thinking about working in Dallas-Fort Worth area of Texas. I am a realtor with Keller Williams Central, and my area specialty is North Texas, which are 6 or 7 counties around Dallas and Fort Worth. Today with me is Jerrett Morris. He is a mortgage lender with Thrive Mortgage, and we are going to talk about a very interesting and little known area of lending called non-QM mortgage loans, and we'll explain what that means in a second, how that affects you as an investor, and why you should watch this video before using hard money lenders or buying a house with or buying your investment property with seller financing. So let's begin by finding out what our non-QM mortgages are and why you think they're useful for investors.
Perfect. Well, thank you for this opportunity to speak on such an important topic. Home ownership is one thing, but buying investment property to increase one's wealth that way is something that's near and dear to my heart, not just because I'm a practitioner in the loans that help people with that, but because I own rental units myself. So I'm very passionate about this, and I love helping people buy that first investment property, and then certainly many after that. So the topic we'll cover today is for what non-qualified mortgages, which we'll abbreviate as non-QM because non-qualified that's kind of a mouthful, but just a quick summary of what non-QM actually means. In the mortgage world, a person can achieve purchasing a house by obtaining a mortgage, either with the more kind of traditional routes, which would be conventional financing. If we're talking about investment properties, FHA and VA really aren't going to qualify. That doesn't work. Those are focused on homes that are going to be someone's primary residence. So the traditional world, you've got kind of your conventional mortgages, and then thankfully in recent years we've had non-QM show up and help say yes to way more people who want to buy an investment property. And so it just means that it's using non-traditional guidelines, and the government helps determine whether a mortgage is qualified or non-qualified via a set of guidelines. And so the non-QM space is a collection of different lenders that are basically making the rules themselves rather than being subject to overarching larger rules by, say, Fannie Mae or Freddie Mac. And so we just have the ability to say yes to more people thanks to non-QM. And in the investment property space, that is a really key thing. So I'll let you take it from there, Lena.
Sounds good. So the reason that I actually decided to do a podcast with you is because I have my own group on Facebook, and that group is called Seller Financed Home DFW. And I was surprised how many investors contacted me and asked me if they could buy a property with seller financing, which kind of shocked me. I said, aren't you guys using hard money loans or something? They said, yeah, but those are risky and hard, and seller financing can be more forgiving. So that brought me to a question, can you qualify for other types of loans? And this is where I found that you can offer something. So a lot of the investors who were looking to buy with seller financing were looking for a buy and hold, or they plan to do a flip. So let me first talk about the types of investment scenarios where non-QM loans would be most useful, and the types of scenarios when they would be less useful. So let's look at the buy and hold scenario. What do you think about non-QM loans for buy and holds?
Yeah, buy and hold can be fantastic using non-QM if a couple of key circumstances exist. Non-QM can be an absolute wonderful tool if we've got an individual, maybe a collection of people who own properties. They own many rental properties. Traditional mortgage guidelines, and there's no hard and fast number on this, most of the time at some point we'll cap the number of properties that have a mortgage on them at a certain number. It can vary, but for the purposes of this call, let's just say 10. That's not hard and fast, but that's just a quick down and dirty rule that if someone has 10 properties, investment properties, and they're all doing well and there's no problem, but they technically have 10 and there's 10 mortgages, in the traditional financing world, sometimes they're going to say, whoa, that's just too many. As the 11th bank, they don't want to be the 11th bank behind 10 other ones in case in case we had something like we did right with the Great Recession.
Mm-hmm.
You know, obviously, if someone has a home that they live in and they have investment property, if times got really hard, they would let the investment property go before the home that they live in and their family lives in. And so the number of properties held as an investment property and to have a mortgage on them, non-QM can sometimes be a fantastic option because they're perhaps not limited by that same number of constraints. That would be for a situation where there's no problem proving income, like that's not really concerned. It's just the sheer number of properties. So non-QM can be great for that. Non-QM can be also awesome, not so much maybe focused on the number of properties, but just if there's concern about the income. There's a certain type of non-QM lending that's just fantastic. If someone owns a property and there's a mortgage on it, it has to be at least one. That means that we get to enter in this one subset of non-QM that would potentially allow us to say, okay, Mr. Client, Ms. Client, you'd like to purchase this investment property. Gotcha. Here's what it would look like. We would get an appraisal on that property, and part of that appraisal, we would learn what they think the house would rent for. And as long as that projected rent is at or above what the mortgage payment is, and there's a certain formula that goes into it, this is a very simplistic explanation, then we don't even necessarily have to look at the income. So if you have someone that is maybe a W-2 employee, maybe they're self-employed, who knows, but on paper, we might have a hard time saying, well, how can you justify that investment property using this alternate calculation method where we're just basically saying, what can it rent for? What is the mortgage payment going to be? Oftentimes that will completely take the other income questions out of the picture, and it allows someone to buy that investment property, and it's no fuss, no muss, it's fantastic. And so that is another beauty of non-QM. So that of the buy and hold space, those are two real gems.
So now let me clarify that. So let's imagine that I'm actually very networked in the IT industry.
Yes.
In the IT industry, people are very low risk. They're kind of hold everything close to their, to their chest. But very often they have a mortgage right now, and they really, really want to start investing because they're concerned about income interruption or whatever. And then I tell them, well, let's try getting you a rental. And they say, well, I already have a mortgage and I could barely get that mortgage, with my debt to income ratio. So how am I going to qualify for another one? Tell me more about how the non-QMs, kind of how that would play with that IT guy.
Yeah, that's a perfect hypothetical scenario where if we looked at the traditional debt to income calculations, we say, okay, you make this much money, you have this much of a regular mortgage, you have a car payment and all these other things, we calculate it, and it says, well, sorry, that's not going to work. We can't add another mortgage on top of that. But we could try this alternate calculation method where we say, okay, gotcha, let's put all that to the side. What is it possibly going to rent for? It doesn't necessarily have to be rented. We're speaking hypothetically, leaning into the appraisal and the appraiser to say, hey, given market rents in this neighborhood for this specific house, I think it would rent for, and I'm making up a number, $1,750 a month. Okay, great. When we do the financing calculations, if the mortgage payment is going to be less than that, and again, there's a formula we have to apply. Well, then guess what? We don't have to consider all those other income constraints. We simply say you have another mortgage, and that is a key component of this alternate method. If someone does not yet own a home and have a mortgage on it, then we can't use this special way of calculation. But that also says, well, most people, if they were going to buy their first house, it's usually to live in. It's usually not as an investment property. Although we've helped people buy an investment property as their first home that they didn't actually live in. But this alternate method really helps people in that instance not even get caught in that other trap and allows them to buy that property. And then the cool thing that can happen, Elena, is once we get somebody in and after a year or two and they do have it rented, now we've kind of offset that figure and we might be able to refinance it down to a lower rate perhaps because we will have now had a little bit of history behind us with the house actually being rented, and those debt to income ratios will have equalized a little bit. So it's kind of a cool thing.
Now, you mentioned refinancing. I think we kind of jumped ahead a little bit. Let's first get to the basics. The non-QM mortgage, who could qualify? As you said, somebody needs to own a house. Are there any other qualifications? Number two, typical down payment. And number three, the interest rate. So if I understand correctly, anytime there is no free meal anywhere, right? The only free meal is in the mousetrap. So if you have this non-traditional mortgage that can be very flexible with your income source, etc., it means something has to give. So what gives in this mortgage? How it's structured?
Yeah, so within the context of how non-QM works as compared to QM, which is tantamount to saying traditional mortgages and non-traditional mortgages. The reason why they're non-traditional, the reason why they're non-QM is they're solving a problem that the traditional traditional mortgage space wouldn't allow. Debt to income ratios didn't work. Maybe the credit score wasn't high enough. There could be any number of things that a conventional loan would say, no thanks, I'm going to go ahead and hold off on that. We're going to pass. And the non-QM space steps in and says, well, we'll be happy to help you. But like you say, there's a trade-off. For the ability to be able to keep moving forward and actually take action and buy that investment property, with non-QM loans, the trade-off is a higher interest rate as compared to what a QM and or traditional financing would be. And so that's where we see it the most, the first and foremost. Down payment, if we're talking about someone who wanted to buy a house as their primary residence, the discussion's a little bit different. But the good news is when it comes to non-QM, it's not really any different than what we see in the traditional space or the QM space. They pretty much want 20% down. The rates typically tend to get better with 25%, and that's in either lending type. So not much of a trade-off there, but we can definitely have more flexibility with investment property for non-QM. Aside from someone who is a business owner and they have some trouble maybe proving 2 years worth of tax returns, or maybe they're underreporting income because they've got a great account, things like that. That, non-QM does fantastic there, and it does equally fantastic in helping investors. So that's really one of the key benefits of non-QM. But to your point, the trade-off is typically a higher interest rate.
Gotcha. So if I understand correctly, just to summarize, and I'm listening to you, non-QM mortgage, you must have at least one house already, right?
Yes, with a mortgage on it.
With a mortgage on it. What if the house is paid off? It doesn't count?
It gets to be difficult. We've had less success with those. It has to do with how the non-QM rules work and what they allow and what they don't allow. And just for the viewers, just very briefly, because if we're speaking to potential investor clients, by default, kind of the assumption is there's a little bit more maybe knowledge of how things work. When the mortgage meltdown happened and there were some very, very, very questionable lending practices where mortgages were given to anybody for any reason, no matter what, the result of that were some very strict guidelines that existed for a long time that said, okay, that's it. We're going to really triple check and document everything. In the past few years, this non-QM space has come into being. And even though it's allowed greater latitude on what we can say yes or no to, there still are some governmental kind of guidelines that come in and say, you're not just giving a loan to everybody. You must.
Dodd-Frank?
Yeah, mainly Dodd-Frank. But basically it's coming down to say, all right, lender, you can kind of make up your own rules if you want to live outside the QM space, but you're darn sure going to find some ways to to make sure that these people can repay this mortgage. You can use some alternate methods, but you're going to find out. And so that's where non-QM still has some guidelines. When we say, well, gosh, why would it matter if they have a mortgage or not? If they own a property, shouldn't that be enough? Well, there's just certain pieces in there, more than we can get into for what our viewers on this call would want to see, or I should say this video. But that's kind of how it goes. Is there, even though there's a wider range of opportunity with non-QM, there are still some constraints.
Gotcha. So we have a requirement to own a house with a mortgage, just to make it very clear. And then it doesn't matter whether or not it was a conventional mortgage, or if it has maybe a commercial loan mortgage on it or something like that, right? Just a mortgage.
Generally a mortgage. If a residential property is being held by a commercial mortgage, that might be an interesting situation. But that's the beauty of non-QM is we have a greater chance than in the traditional space to tell the story, to say, hey, this is why we think this makes sense. Look at all these facts. This is why this should be a good lending decision. But we would take that on kind of a case-by-case basis.
Gotcha. Just because I'm thinking, because a lot of them have LLCs, more than one, right? They might have an LLC, and that LLC has a mortgage, right? This LLC may not have yet a mortgage. So, okay, we're not going to get into it. So bottom line, if you have questions about that part, contact Jerrett and he'll be able to talk to you directly. Now, so we have requirement to have a mortgage, house with a mortgage, approximately 20% down payment, but more down payment is always a good thing.
Yep.
And then a higher interest rate than traditional mortgage. Gotcha. Now that we've laid the groundwork, are there lending guidelines, like, for example, up to 350, up to 490,000, like, what are the top limits for that?
Yeah, the good news with non-QM is it's not subject to what the FHFA, FHFA, sorry, I think I said it right. As far as the guidelines that are set for what's called the conforming loan limit. So currently in the state of Texas, the conforming loan limit is $548,250. And so if you go above that, it's considered a jumbo loan, and that's kind of a whole different thing. But at the end of the day, with non-QM loans, specifically for what we're talking about for investors, in general, those loan limits don't apply. So we don't have to kind of wrestle that to the ground as much, and we have a wider range that we can work through to kind of custom tailor solutions to that person's needs without being so fixated on, oh gosh, are we getting close to that 548 mark? It's not much. It's not that big of a factor.
Gotcha. So if they're looking at buying a multifamily, let's just say a duplex or a triplex, right, where it's obviously going to be more than 500,000, then we can still work with that.
Absolutely, and with whether it was traditional financing, aka QM, or kind of the non-traditional non-QM, when it becomes a multi-unit, 2, 3, or 4, that changes the dynamics. And either space, the general requirement is now we're stepping up to 25% down. So there's some tweaks that kind of happen there. There absolutely positively there's a change in the interest rate when you go from 2, 3, and 4 away from just a single family residence. Luckily for the purpose of this discussion, it's the same whether it's traditional financing or non-QM, but that's things that we would have discussions with our clients each and every time to make sure they understood how it was all coming together.
Hold on just 1 second. I want to make sure that, yes, everything's good. Now, so we talked about buy and hold. That sounds pretty clean and simple, right? We'll look at their current appraisal value, look at what the current rent rates are in the market. Things are very simple. What about BRRR? Because the current condition of the property might be slightly less what it could be once they're done with it.
Sure, and that is an interesting topic, especially as it relates to what we've seen post-COVID. Renovation type financing of any kind, while still around, is just a little different. And so to date, there is not a strong prevalence of non-QM financing that truly addresses that component of the investment market. I'm sure that it will continue to develop, especially over 2021, but at this exact moment, it doesn't have a real good footing. It's so interesting, and I'll be brief about this. At the beginning of 2020, like so many things, the non-QM space, it was coming into its own. It had been building up some steam for a couple of years, and it had just seen this exponential growth and was just getting ready to bust down some doors. And that probably was a natural progression of where we would have seen some additional funding outlets. But when COVID happened, that kind of a lot of that came back. And so, well, that one's just kind of, we'll have to put a TBD on that one for now.
Gotcha. So for BRRR, because of the rehab part, it's still a problematic to get the property using the non-QM, right?
Yeah, just and the bigger issue is the occupancy type, because it's investment property. It's because that represents the absolute highest risk for any lender is an investment property that's going through some rehabilitation, because the worst thing that a lender wants to have to go through is a foreclosure to take the house back. And a nightmare scenario for any bank is to take back a house that's half done. And so that's why there's such a limited appetite in the market for those types of loans. I presume that they'll come back a little more, but for right now, it's pretty specialized.
Gotcha. What about rent to own? So let's just say that I have quite a few clients who are currently looking to buy a rent to own to live in, but they couldn't, like for example, we have 2 primary providers of rent-to-own houses in Dallas-Fort Worth, and those are Home Partners of America and DV Homes.
Yep.
Now, of course, there is a ton of little bitty providers who unfortunately sometimes have very unsavory reputation as well. So I don't necessarily recommend going beyond DV Homes and Home Partners of America. But from time to time, I'm asked to find an investor. So I have a very good case. You know, these people are perfect for a rent to own. They have great down payment, all of that stuff. But they're looking for a private investor to deal with that because DV Homes already, for some reason or another, rejected them. And I have an investor. An investor is ready. So my client's are ready. The investor is ready. The investor says, how do I buy that? So on that particular case, the house that my clients, rent-to-own clients, will probably choose will be move-in ready in very good condition. The investor just needs to be able to acquire the property. Would that work for you guys? Because after about 3 or 4 years, they will be able to buy the house, right? Once they finish their rent-to-own.
Yeah, and so that is difficult for an investment property. Now, if someone's going to live it as their primary residence, that's a different story. But if they wish to kind of do that rent to own with non-QM on an investment property, currently, to my knowledge, there is not a mechanism for that. Yes, we can skip the rent to own if someone's going to live in it as their primary residence, but the alternate version, I don't know everything, for goodness sakes, but I've been doing this for a long time, and I try and keep my finger on the pulse of what's available out there. I am not aware of an outlet that would satisfy what you're describing.
Gotcha. So even though we can do it for a regular rental, rent to own would not be a good fit, right?
Yeah, just because, again, it just has to do with the occupancy type, because it gets very complicated as far as like, well, if it's rent to own, who's the owner, like at what point, and the financing, because anytime financing is involved, there's a lien placed on the property, and that lien is very, very interested in who the actual owner is, because the way that foreclosure rights work and the foreclosure process works, I can't speak to every state, but how it works in Texas, we kind of need to know how that is, and no lender, non-QM or otherwise, are going to want to put themselves in a position where they're perhaps once removed from the ability to foreclose if the mortgage goes into default meaning that the payments were quit being made. So like I said, there might be some really highly specialized lender out there. I'm just not aware of any that would handle that for an investment property.
Gotcha. Alrighty. So now it sounds like the flips would be out, right? Because we don't, these type of investors are not necessarily interested in taking possession of something that is falling down currently. And from what I'm hearing, there is little appetite for creative financing like wraps, right? So if I took this property, let's just say I have a great property that I'm planning to buy using non-QM mortgage, but then I plan to wrap that mortgage and offer it as a seller finance property to someone else, that would not work, right?
Yeah, to speak specifically to the wraps, that would go very, very poorly for just about anybody who tried to do it. There was a time in the past where wraps were kind of a thing. That's just not the case right now. Flips, that could be more case by case. It might be that the house is in okay enough condition that the lender would say, I'm not thrilled about it, lender being us as the bank. I sometimes speak in a weird lender third person. But us as the bank, we could say, we're not thrilled about the condition, but it meets minimum standards. We'll go ahead and give you the loan. The issue with non-QM as it relates to investment properties and flips is if someone was seeking a non-QM loan to be a house that they were going to live in as their residence, as their primary residence, there is almost never a prepayment penalty. In fact, I don't even know if it's possible to have one legally.
However, no, I don't think, not after that, Frank.
But however, on investment property, it is absolutely permissible. So the reason why that's not usually a good fit as far as non-QM financing and a flip is that prepayment penalty is almost certainly going to kick in, because that's the whole point of a flip. Buy it at a great price, fix it up, find a wonderful buyer who's excited to buy it, and everyone goes down the road. That time frame is not in line with the prepayment penalty time period. So it's not that we're specifically prohibited from doing a flip property with non-QM. It just probably doesn't make financial.
It would make sense, right? Yeah, it would make sense. Speaking of the prepayment penalty on them, do you know the time frame on those?
It depends. And so typically 2 years is about what we see.
Okay.
We're starting to see a few that are sneaking in around the 3 year mark with a trade-off in interest rate. So as a viewer who's seeing this might imagine, the longer the prepayment penalty period, the more that the rate might come down, and then the shorter and the higher. And so that in the shortest we've tended to see is 1 year, but we're now starting to see come around 3. The standard is pretty solid at 2 years across the board for investment property using non-QM.
Gotcha. That's actually very good to know. So if they're planning to buy and hold that property for the next 40 years, then they could potentially trade off a longer period for the prepayment penalty for the lower interest rate, right?
Exactly. And as we look at the prepayment penalty, to harken back to something we talked to, a few minutes ago, with any non-QM loan, we're always evaluating it from the standpoint of, is this a stepping stone to get us to something better financing-wise? Does this allow a client to purchase and acquire an investment property? Ultimately, will their financial situation change where they might be able to switch it over to more traditional financing? That prepayment penalty is part of our analysis where we might say, hey, look, take the higher rate for the 1 year prepay because we project in 1 year your financial situation will be such where we could refinance to a lower interest rate and it'll be worth the higher interest rate for a short period of time to have the freedom to refinance and have less expensive financing over the long haul. These are the kinds of things that we help our clients look at. It's never just slapping a mortgage together and sending them down the road. We're trying to look at this long term. This is the largest piece of debt that anyone will have, including if it's an investment property. We have a responsibility to help people professionally manage it, and these are the kind of questions we look at for them.
Sounds good. One thing about hard money loans that I found out that a lot of hard money loans providers want to know your history. They want to know that you have done deals in the past, how you've done them in the past. And the newbie investors are stumble on that part because they have nothing to show on that. So what would be let's just say that I have somebody who is fresh out of, let's just say fresh out of college. They're currently in IT position, right? I have a lot of IT friends. So that's my typical friend. Fresh out of college, have good degree, have IT position that give them maybe 70 or 80K per year, have great growth potential for their career, and they want to start investing. They have zero in experience as landlords or as investors. What are the minimum requirements that you would expect to have?
Yeah, so the good news there is whether non-QM or kind of more traditional financing, if we're looking at someone who wants to purchase their first investment property, there's not a large requirement other than them having a satisfactory credit score, a suitable debt to income ratio, depending on which type of financing we're using to get across the finish line, and then the appropriate down payment. That's about it. And so that should be good news to people, that the barriers to entry to buying that first investment property, which we help investors every single month, that should be music to the viewers' ears, is that you don't have to have proven that you've been a landlord. There are some subtleties if we try and use rental income to offset the debt to income ratios. In that instance, there should be some guidelines that could kick in and say, well, hang on just a minute. I'm not going to, this is the bank talking. We're not going to let you count this as income until we can prove that you've done this for a while or you've got some experience. But as far as just being told, can you even get the mortgage to start with? We don't typically have any requirement of that because by default, we'd never be able to give anyone a mortgage on that level because somebody's got to start somewhere. Yeah, they got to start somewhere. I wouldn't have been able to buy my first rental property if that was the case. And so, because I'm passionate about helping people with rental property because I know the power that it brings to my own personal wealth portfolio. And so that's the good news, whether it's non-QM or traditional financing, as long as we can satisfy the other requirements, they don't necessarily have to have had any landlord experience.
Gotcha. Okay. And when you say satisfactory credit score, what would you expect to see on a credit score?
Yeah, that's a good question. So as it relates to, I know we're speaking more about non-QM, but just kind of a larger basis. When we're talking about an investment property, by default, the bar comes up for either financing type. So, in another video series we've talked about what it could be for someone who's going to buy as their primary residence. that credit minimum credit score could be much lower. That's not necessarily the case for investment property for either traditional or non-QM financing in general. And this is a broad statement. Don't take this as the definitive word for every single person, but minimum kind of in the mid to upper sixes is where we're going to be looking for folks, which, to be frank, that makes sense. We are not comfortable putting folks in their first investment property if they've not kind of gotten their house in order, because buying an investment property is buying another business. It is. And so we really feel more comfortable if people have kind of demonstrated they've kind of got their financial house in order. And so it kind of goes very nicely that there should be a higher credit score. So we really like to see that they're kind of in at least the mid sixes, and the higher the better, not only just for the peace of mind that it's the sensible thing to do, but the loan terms will be so much better.
Gotcha. Okay. Well, I think that's all I have for right now, because I'm kind of new to this topic of non-QM loans. If I have more case studies for you, I'll be glad to bring you back and have you kind of go over with me over some case studies. In fact, those of you who are listening right now, if you're interested in finding out how it could apply to you, make a comment, say, this is my situation, how would that apply? And I will make sure to bring Jerrett back and ask him how he would do it, and he will go step by step on how he would approach your problem. So don't be intimidated. Contact Jerrett. Just say, this is my problem. I don't fit maybe right now the requirement that you stated in the video, but I still want to try. So give him a shot. So Jerrett, tell me a little bit more about Thrive Mortgage and how you guys are different. Like, I never heard about non-QM mortgages until I spoke with you. So why aren't more people doing it, and how are you different from your peers?
Sure, that's a great question, and I appreciate the opportunity to be on this video and kind of explain all of this, including how we believe that me and my team are different. Thrive Mortgage is a mortgage bank. However, we have the capability, especially within the non-QM space, to act as a broker, which just means it's the best of all worlds for anybody that might choose to work with us. The majority of the loans we do in-house, but for special situations, we can find the right perfect lender and kind of broker it out and get it square with them. And the non-QM space is a perfect example of that.
So if you cannot do it in-house, then you give it to somebody, then you find investors from somewhere else, right?
Yep. And it's typically we only did it for the non-QM. Pretty much everything else we do in-house. We do certain loans that no one else does. So within the scope of buying a home for any reason and you need a mortgage on it, with rare exception, if it can be mortgaged, we can do it. And
you and I might need to talk a little bit more after this, because I think I have some wonderful clients for you, but go on, I'm sorry.
So yeah, and really, I think what makes me different compared to some of my peers, if nothing else, I've been doing this for a while now. I've been going on 19 years, so I've been around the block. I've helped thousands of people have conversations like this and get them across the line. As I mentioned earlier in the video, I'm passionate about helping people buy investment property because I understand the power of it personally, as well as just as a practitioner. And so we just bring a lot to bear, my team and I, as far as providing peace of mind and letting people know we've got your back. We're not just going to put any mortgage together. We're going to listen to your needs, your short, medium, and long-term needs, and customize a solution that works with it. We don't ever want the mortgage fighting against somebody, but want them working with them. And that is especially true when it comes to investment property, because it's got to work in concert. There's so much at play there. In the hands of an unskilled professional, what could otherwise be a wonderful wealth building opportunity could turn into a mess. And that's why we take that responsibility so seriously, especially as it relates to investment property purchases.
So you're kind of like a customized investment loans provider, right? You can tailor a situation to fit the investor's needs.
Yeah, and not only just investors, really anybody that needs a mortgage on any property. Maybe they want to buy a lake home or a second property. Maybe it's their primary residence, or as we've spoken on this video, an investment property. You know, a mortgage is one of the largest pieces of debt that anyone will ever have. We have a responsibility to help people professionally manage it. That is a quote I learned from an industry leader. His name is Todd Duncan, and I've taken it to heart way back when I first got into this business, and it's never steered me wrong. It's what helped me give my clients peace of mind, so they know they're getting the right solution every time.
Gotcha. Well, everybody, this was Jerrett Morris, and he is with Thrive Mortgage. Feel free to give him a yell, 972-385-1300. And just FYI, in case you're listening to us and you're not from Texas, so we're in Dallas, Texas right now. If you're not from Texas, Jerrett is licensed in the entire state of Texas. So if you have a property you have your eye on and it's in state of Texas, please contact Jerrett. If it's not in the state of Texas, contact Jerrett anyway, because he has a large team. But go ahead, Jerrett. What do you have to say about that?
No, you said it fantastically. I'm only licensed in Texas because my goodness, Texas is big enough. But I have a team of colleagues within my company, and even outside of it, I've got a wonderful resource network. So if you happen to be somewhere outside of Texas and you've got questions on this, good news. This information applies the same. It just happens to be a different state, and I'll make sure to get you connected with somebody that would take care of you the same way that Elena and I would.
And do you know how many states Thrive in, or do you have to have an office in the state to lend in that state?
Well, that's kind of a hard question because every state's slightly different as to whether you do have to have an office there or not.
Never mind.
We are licensed in most states, and for the few that we are not, again, I'm part of a nationwide network of real estate professionals, top notch, the very best of the best. And so, just as they send me folks, I send them folks, and it's a wonderful reciprocity that goes on to make sure that even though I can't help directly, I know beyond a shadow of a doubt that they'll be taken care of it the same way that I would.
So everybody who is listening, if you're thinking that non-QM mortgages are right for you, but you don't know who in your state is providing non-QM mortgages, contact Jerrett and let him direct you to a right provider.
Yep.
Correct?
That's correct.
Sounds like a plan. Well, thank you so much, Jerrett. We are at the end of our conversation today. Again, my name is Elena Garrett. I'm a realtor with Keller Williams Central. I'm both residential and commercial realtor in case anybody is interested in commercial investments. And please don't forget to hit like and subscribe. Now, what's coming up next is I'm going to continue to bring Jerrett in to talk on a few more topics in the future to help us to see what are specific solutions. We might do some case studies. We might do some additional types of situations where we can explain how can we take an investment opportunity and how we can put the mortgage on it. So stay tuned, subscribe so you don't miss any one of our videos. In the meantime, have a great day and see you at the next video.